Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Bytes. We're shooting this episode on 6th of June. And in today's episode, we will have a variety of Twitter insights from the day, ranging from real estate to the US markets. But first, a look at our markets this afternoon. Nifty closing at 18,600, pretty much where it started the day at. What the chart is not very clearly suggesting or showing is the intraday dip that we had today. It almost went down, covered that gap in the chart that is there, and has strongly come back in the last hour. So, Nifty displaying strength in terms of that it does not really want to go down and sticking with a closing very near the recent highs and also not too far from all time highs. So this is a clear indication that the market is very very strong, and minus the odd corrective day that we get, the market is not really willing to go down. And the heat map also looks reasonably uh, tilted towards green, where Kotak Bank, Axis Bank, etc. were leading the banking charge. Tata Motors, Maruti have been on a huge run up, along with Mahindra and Mahindra and Eicher Motors. Ultra Semco, Grasim also doing well. Some softness in IT stocks, TCS, Infosys, Wipro, and Tech Mahindra. Some softness in power stocks or power related energy stocks, Coal India, ONGC, etc. But other than that, we had some reasonably good day. And if you see the makeup of the sectoral map for the day, real estate again moving 1.2% high, autos again moving 1.1% high. So if you have been watching these episodes, you would have seen that there is a pattern that whenever the market is leading on the higher side, you will see real estate and autos do going up first, and whenever it drops, it's usually led by IT or maybe even energy stocks, etc. So these are shades of medium to short term momentum that you're seeing, that spaces or sectors in momentum tend to go up first at the very first instance that the market starts to look up, and the ones that are weak tend to drop the first when the market is looking down. So overall, if we see in the last 1 week, real estate and autos along with pharma have done well, 3 to 5% gains. IT, energy stocks, and bank nifty have done fairly poorly in the last 1 week. These are the only sectors that have been red. Mid cap index also had broken the 2 day low, came down, almost filled this gap here, and retraced back in the last hour. So again, even mid cap index has closed very near its highs. Small cap making another new high at 10,125. The rally is strong and continuing. No reason to disbelieve the rally. Of course, some stocks, some sectors are becoming overbought and they may go into consolidation while other sectors will rotate. So that is the beauty of most bull markets, is that sectors keep rotating, like just like a relay race, giving from going from one sector to the other. Nifty bank has been stagnant last many sessions. Today some selling towards 44,000 but quickly recovered to 44,150, and that has also not given up its position. So as I mentioned, today will be only insights from Twitter. So 3 4 insights from Twitter from different uh, genres of discussion. So this is one from Haver Analytics. It is just showing the manufacturing unit labor cost dollar per hour, and the orange line is that of China. And you can see that China after 2008 has suddenly deviated, and the cost of labor has been dramatically going up in China. I think this is a huge advantage that other countries like India, Vietnam, Thailand, etc. will catch on to. And I'm hoping that this trend that India has had, if you can just see this brown line, it is secularly up. However, the momentum is not as good as one would want it to be in terms of labor cost. So some wage increase along with inflation is good to keep the ball rolling, but to have stagnant wages is kind of maybe not so good. But the more it stays in that band along with other countries, I think we remain competitive. And of course, this is a dollar per hour, so in rupee terms, the wages are increasing, so not an issue at all. But yes, I mean, we have now the huge gap between India and China, where the arbitrage of labor can be played. This insight is from Tavi Costa of Crescat Capital. This chart actually is a gold to US Treasuries ratio chart. So, the chart actually is showing how, gold versus US Treasuries have behaved over a period of last 50 odd years. Um, and what we are able to see here is that the Treasury total returns index divided by gold. So essentially, what happens is that as interest rates go up, those who are holding treasuries, their the returns will collapse, as is happening now, because interest rates go up, bond prices go down. So, and it goes and hits a crescendo kind of a move, and the gold cycle actually goes up along with those increasing rates. So you can see that in 75 to 80, you had a very nice cycle here. Then from 2000 to 2009-10, you had another gold cycle here, and now we are setting up for a huge run up again in this cycle. So all this is pointing to good, returns for gold. So this is something that one can look at. Another good insight that I saw today. I'm sorry, I should have put the credits from which account I got this. But anyway, so this is a simple chart of S&P 500. The blue line, the light blue line, if you can see this, the dark blue line is a 50 EMA line here, and this one is a let me just see, the red line is the 200 EMA line here, and this is a monthly chart. So what we can see here, sorry, a weekly chart, and what we can see here, that this death cross that is called. So death cross is a name given to a situation where the 50 moving average crosses the 200 moving average on the downside. So the blue line cutting the red line from the top is a event called death cross, that it is signaling that the market may go into a extreme downward mode. So it has happened 4 or 5 times in the past decade or so. In 2011-12 it happened, then in 2015-16 it happened, then in 2018-19, then in 2020 COVID times, and in 2022 also. And now it is again crossing on the downside. The previous times, the 5 times it has done that since 2010, the fall in the markets have been 20%, 18%, 20%, 35%, 25%. So very near around 20% fall. And if this were to play out again, then we could be looking at, say, fall down to somewhere close to 4,800 or 4,700 on S&P. So this is a very, very critical moment where either this will be played out as per past instances, or this will be a failed attempt of a S&P 500 death cross. Now, lastly, a very uh, nice old advertisement uh, was put up by Vishal, and it says that a real estate agent offered a price of 2000 rupees per square meter for a plot of land in the Bombay reclamation area. And it is almost, and this is the year 1967, something like that. And whenever we look at real estate, and there were other bids which were much lower than this, and the idea here is of the insight is that 2000 rupees per square meter seemed a lot of money in 1967, probably was a lot of money in 1967. And uh, that the fact that you know you always have a rear view sort of mirror looking at prices. So the current price always seems that it has gone too high, and potentially will not go up at the same pace or higher. But if you see the last 50 years or even more data that is available on real estate, on gold, on stock prices, every time you will find that wherever you found these assets to be too expensive, yes, some short term corrections may happen some places, but when you will see them 20 years hence, 30 years hence, 40 years hence, those prices will look like a steal that you should have begged, borrowed, and somehow got it at that time. So if we look back even in the stock markets, HDFC Bank was available at 20 rupees, or Eicher Motors was available at 50 rupees, or things of that kind. So the current prices, psychologically, because we have not seen higher prices than this, and this is the highest point. So again, going back to that all-time high debate, where all-time high prices of stocks seem illogical to buy into, because we have seen lower prices and we are somewhat anchored at lower prices, that this was worth 50 rupees, now it is 100, so it can't be 100, it should go back to 50. That is our sort of, by default, our the mind works that way. Whereas the price is telling you that I've gone from 50 to 100, now possibly I may go from 100 to 200 also. And over a period of time, with inflation, with more people wanting to buy the same asset, it will keep going up. So that 2000 rupees per square meter, maybe now 5 lakh rupees a square meter. I don't know what are the rates in Mumbai. They must be high. But and real estate returns will beat inflation, gold returns will beat inflation, there is no doubt about that. But the fact is that the all time high prices that we see should not be feared, because they are sort of a testimony of what may be coming forth, and that is how one should look at this. So last sort of insight or tweet of the day is about BSE, Bombay Stock Exchange. And today NSE announced that they are going to have the Bank Nifty expiry on Fridays instead of Thursdays, and BSE was targeting Sensex expiries on Friday to corner some volume away from NSE. And now NSE, in a business decision to not give up market share, has struck back by shifting the Bank Nifty expiry to Friday, so that traders don't have to go to anywhere else to trade on Fridays, the expiry traders, and they stay in the NSE, and NSE can continue to get transaction cost and retain that market share. And this is, I can tell you a small story about this. In 2000 or 2001 sometime, uh, or maybe it was late 99, there used to be a 5-day settlement on the NSE. So Wednesday to Tuesday was the settlement cycle. So if you bought stocks on Wednesday, you could hold them till Tuesday, square them up if you wanted to, and then at the end of Tuesday you had to decide whether you wanted delivery or not. So you had that 5 days periods to play the stock. Mumbai Stock Exchange at the same time used to have a settlement for Monday to Friday. So you could buy on Monday and sell off by Friday, right? So there were these two cycles that were sort of Wednesday to Tuesday and Monday to Friday were the two cycles. So people, what they did was that they would, let's say, go long in a position on Nifty on NSE on Wednesday, and then when Tuesday came, they used to square up the position at NSE and simultaneously take a position on BSE for that same stock. And then the next day on Wednesday or on Thursday, they would close the position on BSE and bring it back on NSE. So this way, without having to take delivery, you could continuously, run your cash stocks because futures was not available at that time. So this is how that Badla system used to work, where on the other hand, people who were supplying these stocks, like I did this arbitrage a lot, where just offering these stocks to these people who wanted to go from one to the other or offering capital to them, you could make like 3-4% a month clean arbitrage without any issue. So this carried on for some time. BSE tried to take away that market share, but then the rolling settlement came on, and it became a daily settlement. So just a small historical piece of story there. But this is all I had for today's daily bite. Thank you so much for watching this, and I'll see you in the next one. Bye.